Hello and welcome to this YouTube video presentation. And on this particular video, I want to look at an area which I believe that ACCA AFM students sort of struggle with when it comes to the concept of dealing with working capital cash flows in advanced investment appraisal. Okay, so what I want to do is first of all explain the concept, the principles, the ideas behind it, and sort of my thought processes. How do I think about dealing with this particular area? Then I want to take three sort of extracts of past exam questions and show you how you would basically treat them within what is going to be the ACCA spreadsheet. Sorry. So let's have a look at what is going to be the concept here. So let me just roll this down. Okay, the concept and approach, right? We know that when we are going to produce a net present value or an IRR or an MIRR or an APV, we've got to get to the free cash flows for the company relating to that particular project, the future incremental free cash flows of the company. That includes, or you must ensure that we've set aside money for investment in the non-current assets, which is the what we call the capex, yeah, and obviously we also have the scrap value, yeah, but also working capital flows. And in a standard pro forma for investment appraisal, the working capital flows would be the last set of flows before you do the totaling of the free cash flows, because the working capital flows have no effect as far as tax is concerned. And that's the first point. Where do you put them on a standard pro forma? Right at the bottom, just before you do the totaling to your free cash flows. Okay, how do I think about what working capital is? Yeah, and you can see here I put my 3 points of how I think about it. First of all, I think that for every project we open a bank account. Now, I know that isn't true. Yeah, in reality, that isn't true, but this will help you get round the issue. So think about the fact that what you're going to do is for every project, open a little separate bank account. And that bank account must be there to fund the labour cost and supplies, supplier payments and general expenses from the day the project starts, time zero, to the day effectively the project ends, which for most of our questions we know is normally years 4 and 5. Normally, yeah, not always. I'm not looking for a perfect scenario, but normally years 4 and 5. So think about that you're having a separate project bank account for each of the projects that you have. Now, you've then got this next line: invest, adjust, close. So what do I mean by that? Well, at the start of what is going to be the project, time zero, you've got to put some money into that particular bank account. You've got to invest. There's got to be what we call a negative. There's got to be an investment, taking the money out of the normal corporate bank account and then putting it into this working capital project bank account for our specific project. That money that goes in at time zero, I don't deny to you that in reality, that money between 0 and 1, 1st of January to 31 December, think of it that way, will go up and down. It will go up and down. Yeah, it will basically be used, replenished. But at the end of year 1, we have to assume that what we put in at time zero is still there. We recognize in reality that it goes like this between 1 January and 31 December. But at the end of the year, we have to assume if we put 200 in, there's 200 there. And that's because the discounting is done on an annual basis. Then what we do is we have to normally adjust. That's normally going to be a positive. Occasionally it might be a negative, but normally it would be I'll rephrase that. It will normally be an additional investment. Yes, it may be possible that we have to take some money out the account, but for most scenarios, we have to put some extra money in, another negative. Yeah? And That is to fund our activities between year 1 and year 2. And again, that will go up and down, up and down, up and down. Then we get to the end of year 2 and we have to do the same. And this adjustment, like I said to you, for the majority of adjustments that we do at what is going to be the end of year 1, end of year 2, end of year 3, hypothetically, most of the time we're putting more money into this bank account. Occasionally, we may have to take money out. We may have too much invested. But when the project closes, when the project finishes, we've got to take all of the money out. We've got to close that particular project bank account. So if you think about it like that, that's really going to help you. It really, really will help you. Yeah, this idea of what is going to be invest, adjust, and then close. Okay. Finally, last but certainly not least, is you've got to read the question very carefully as to how they want you to do these incremental cash flows. How do they want you to set it up at time 0? And more importantly, how do they want you to adjust it year 1, year 2, year 3? And remember, I'm assuming a 4-year project just for the sake of my video here, that they're effectively in years 1, 2, and 3. How do we adjust it? And then it's all got to come out. Now, this is why I'm going to use 3 illustrations to show you how we deal with that particular scenario. It's particular to do with this wording of dealing with the incremental cash flows. So I'm going to first of all show you the example wording, then go to what is an Excel sheet. I've taken it off a spreadsheet into Excel and show you how I would treat that within what is going to be an exam question. So let's have a look at illustration number 1 to open up with. So here we have illustration number 1, which came from the most recently published exam question from at the time of recording this particular video, most recently published ACCA AFM exam question. So you've got some pre-tax contribution, which happens to be 40% of revenue. And the wording extracted from the question, which I'll read here, the project will also require an investment in working capital at the start of each year. Start of year 1 is year 0. Start of year 2 is year 1. Start of year 3 is effectively year 2. Yeah? To be equivalent to 2% of that year's expected pre-tax contribution. It is expected that the working capital will be released back in full at what is going to be the end of the project. Okay, so let me go into my spreadsheet here and show you how I would deal with what is going to be that particular scenario. Okay, so you can see here on the spreadsheet, right? And this would be, for me, this would be a working, right? So what I'm doing here is a working, and then I will transfer the information across from the working into what is going to be at the bottom of my investment appraisal. Like I said, just before I total up. Yeah, and I tend to do my workings in the exam on the right-hand side. I always want to make sure the marker is really happy, right? You make a marker happy, the world's a better place. The world's a better place. Yeah. So you can see here, I've just put in the contribution figures. Yeah. Then I've said, what would be the working capital that we're going to need to fund that contribution? Yeah. And that is, as you can see here, 2% of what is going to be the contribution. And in the exam, you can copy and paste the equation across, and you've got the 2% effectively there in that row there. But remember the rule I've just mentioned to you. We must set up the working capital. We must then adjust it effectively each year. And then we must close it. Yeah? So we know that we need to have enough money at the start of year 1 to fund 2% of what is going to be the contribution. So we have to invest what is going to be the 0.88. That money goes up and down, up and down, up and down. We get to the end of year 1 and we say the 0.88 has got to still be there. Yeah, and that's the assumption that we make. What do we need in the following year? We need 1.1. But we've already got 0.88 invested. So I only need to top it up by 0.22, the difference in the two values. So I've now got 1.1 invested at year one. And that value goes up and down, up and down, up and down. Get to what is going to be what is going to be year two, and I go, okay, that 1.1 is still going to be there. How much do I need the following year? 3.7. So again, just take the differential, take the differential and top it up. And you can see that same approach, the following period, that value will still be there, 3.7. We need 9.28 for the final year. At the start of year three, top it up with 5.58. And this idea that at the start of the year, we are topping it up for the level, the total working capital we need at the end of the period. The total capital we need at the end of year one, we've got at time zero. The total working capital needed at year two, total value, which is 1.1, is there invested in year one, etc. But the golden rule is this row that you're going to put onto what is going to be the project appraisal line, it must always cross cast to nil. Open the bank account, adjust it each year, close it. It must cross cast to nil. There, cross cast to nil. So I just basically total them all up. Yeah, you can either use a calculator there if you want to, or you can see here I've just totaled up the negatives and converted into positives, and out comes the value. And I always, when I put that crosscast to nil, if I want to use my calculator in the exam room, I always tell the marker, in effect, in that number, what I've done. Yeah, so if I put crosscast to nil, they'll know, okay, I may have used my calculator of a wish there to get to that particular value. But that's the first illustration, the first type of question that you can get in relation to dealing with what is going to be working capital. Let's look at the second one. So with this second one, Luke Company will also need to make an immediate investment of 2.05 million in working capital. The working capital will be increased annually at the start of years 2 to 4 by the inflation rate and is fully recoverable at the end of the period. Start of year 2 we know is year 1, start of what is going to be year 3 is year 2, etc. The inflation rate in the countries where Luca is located is 4% in year 1 and 5% respectively in years 2 to 4. Okay, so this is adjusting the working capital investment by using inflation rates. Again, let me look at what is going to be the spreadsheet and show you how we deal with this one. Okay, so for this one, I would actually not do a working for this one. This is one where I'd put it straight onto what is going to be the bottom of what is going to be my investment appraisal before I total for the free cash flows. So, and I'm working in thousands rather than millions on this one. That's perfectly okay. So my initial investment, they told me that one. Then it tells me I've got to adjust for inflation at what is the start of year 2, which is year 1. And the inflation rate is 4%. So I've got to top up the 2050 by an extra 4% to make sure I have a total. The total will be 2050 plus that 82. That's the total invested at that point in time. And then when I come to the next year, basically what is the start of year 2 effectively? So I've got start of year 2 is year 1. I've made the adjustment. The start of what is going to be year 3 is year 2. And I've got to then say what would be the inflation rate in year 2? Well, it's 5%. But I've got to be careful. What I'm looking at is 5% of the total invested in the account at what is going to be that point in time, which is the 2050 and the 82. Yeah? So basically what I'm saying, I've put in 2050, I've topped it up with 82, so I've got a total investment of 2050 plus 82. It's 5% of that particular total that's got to be the incremental adjustment. Yeah? Then I go to the next year, and it's got to be 5% of the total value that I've got invested. And this is, like I said, it's a little bit of awkward wording. Yeah, it's a little bit of awkward wording. But then remember what you've got to look at. Remember the fact that once you've put that money in there at the start of zero, then effectively that's going to go up and down, but it's still there when you get to year one. So you've got to adjust it. And then the 2050 plus the 82 goes up and down, up and down, up and down. But when you get to year two, it's still there. So you've got to, how much have you got to add to it? It's got to be added to it what is going to be 5% of that total and 5% of the total of all three. And then you cross cast to nil. And here you'll notice, again, I've done a negative total there on those values. Again, you could always do simply, just do what is going to be, use your calculator. Just use your calculator and use it. I always put that in, even if I put it in the body of my answer, I still put that cross cast to nil there. That way the marker will then, know that, yeah, I've understood the principle of how working capital is going to operate. So that's going to be what is going to be situation number 2. Let's look at the final one, situation number 3. So situation number 3, you can see some sales figures here for years 1 to 5, in thousands. Initially, working capital will be 20% of the first year's sales revenue. Thereafter, for every $1 increase in sales, there will have to be a 10% increase in working capital. That also means that if the sales value was to fall, that means the working capital would effectively come down. Yeah, so you can, when it's talking about an increase in sales, it means an increase in investment in working capital. It automatically means a decrease in sales means a reduction in the investment, taking money out of the working capital account. So let's look at what is going to be how I would present this within the exam. Now, would I have a working for this one? No, I wouldn't. The sales would be right at the top of my investment appraisal. So they'd be my first line of my investment appraisal. And if I went down it as normal, I'd have sales, then I have some sort of variable cost, incremental fixed cost, TAD, taxable profit, tax, add back TAD, ready for the working capital. Yeah, ready for the working capital. Yeah, so I'll rephrase that again. I should have said, I'll do that again, right? I've got the sales at the top. I've got any sort of cash costs. I deduct my TAD. I get to taxable profit. I work out the tax. I add back the TAD. I put in my capex and my scrap value. And now I'm ready for my last line, working capital. And since these values are already on the top, then what I'm doing is going straight, now go to my bottom, my working capital, and I've got to follow what they've told me to do. And they've said, for the first year, times 0 to set up the investment must be 20% of the first year's sales figure, as you can see, minus 20%, because it's an investment. Then, for the next period, it's a simple equation. It's minus 10%, because it's going to be for every $1 increase in sales, for any $1 increase in sales, we've got to increase the investment. We've got to put more in. Incremental investment has to be 10% of the difference in sales. 10% of the difference in sales. And because we've set this equation up in that form there, that would automatically mean if the sales go down, the working capital would be a positive number, which is correct. You should be taking money out rather than effectively putting it in. And again, you can now just copy and paste that equation. 10% of the difference in the sales, 10% of the difference in the sales, 10% of the difference in the sales. But now, you've got to bring this all out. And this is where I do use my calculator. I must admit, I do use my calculator here. Yeah, so you can see there, I've just punched that figure in, and I just used my calculator. Just totaled up all of those negatives. Yeah, total all those negatives, and that basically out it comes at the end. But you notice all those examples follow the same principle. Invest, incrementally adjust each year, and then all must come out at what is going to be in the final period. Now, what I've shown you with those three illustrations is the way to ensure you get the maximum marks on working capital. And sometimes working capital could be only worth 1 mark. So therefore, you've got to get it all right to get the 1 mark. There's no half marks in AFM. So either you get it right and get the 1, or you don't get it right and we get the 0, right? But sometimes working capital could be worth 2 marks, depending on the degree of difficulty. So I just want to show you or talk to you about a way of getting 1 out of 2 and speeding up the process. You won't get a perfect, obviously you're not going to get a perfect answer, but at least you could get what is going to be, if it was allocated at 2, 1 out of the 2. And let me go back to what is going to be a couple of my illustrations to show that. So what do I mean about the idea of if it was worth 2 and you could just get 1 out of the 2? Take illustration 2. Say what you did, possibly because you were under time pressure in the exam. You put the negative 2050 in. You don't bother with that. You don't bother with that. You don't bother with that. And then you put a 2050 positive coming out. Now, it's not correct. It's not 100% correct. And if the answer is worth only 1 mark, I'm sorry, you're not going to get that 1 mark. But if the answer is worth 2 marks, if this part is worth 2 marks, which it could well be, because some things are worth 2 marks in the exam, you'll get 1 out of the 2. And you get 1 out of the 2 because, in effect, have you accrued for working capital? Yes, you have. And what, in effect, you're saying is that, here you've at least shown the principle of it and you've saved yourself a bit of time because of the time pressure within the exam. And it's, like I said, not a perfect answer. It's not what I'm recommending as the main body of this video. I'm doing it at the end. Yeah. But at least you could get 1 out of the 2. And 1 out of the 2 could be the difference here between, not succeeding and what is going to be succeeding. Similarly, you could do the same with this one. If it is worth 2 marks, and you're under time pressure, put the minus 1500 in. 0, 0, 0, minus 1500. Positive 1500. I'll rephrase that. Put the minus 1500 in. 0, 0, 0, 0. Out comes the 1500 at the end. Crosscast to nil. Okay, and this one is going to have a significantly different answer. But at least you might get 1 out of the 2. I'd rather you do it full and get the full mark. Of course I do. That's the main purpose of this video. But I'm also a realist. I'm also a realist. In the exam you have time pressure. And if you can get around that problem, by still showing the principle of working capital, fantastic. And that's really what you are looking to do. If under time pressure, it will give you what is going to be a time saver. So I hope you found this video helpful for what is going to be when preparing working capital cash flows in advanced investment appraisal. If you want any sort of further guidance, you've got my contact details there. And whenever you're going to sit your ACCA AFM exam, I wish you all the very best. Stay safe, stay well.